HELOC stands for Home Equity Line of Credit. It is a type of revolving credit that uses your home as collateral. A HELOC is a line of credit that allows you to borrow money up to a certain limit, usually based on the amount of equity you have in your home. When you take out a HELOC, you will be able to borrow funds as needed, up to your credit limit, and you will only pay interest on the amount you borrow. HELOCs are commonly used to finance home renovations, pay off high-interest debt, or fund education expenses. HELOCs can be a good option for homeowners who have a lot of equity in their home and need to access funds for a specific purpose. However, it's important to remember that a HELOC is a form of debt, and using it unwisely could put your home at risk. Before taking out a HELOC, be sure to carefully consider your financial situation and ability to repay the loan. HELOCs and home equity loans are two types of loans that use your home's equity as collateral. While they are similar in some ways, there are also some key differences between the two. Here are some factors to consider when comparing HELOCs and home equity loans. Repayment terms. Home equity loans typically have a fixed interest rate and a fixed repayment term, which means that you'll know exactly how much you need to pay each month and for how long. In contrast, HELOCs usually have a variable interest rate and a flexible repayment term. This means that your monthly payments can vary based on the amount you borrow, and the repayment term can be extended as you continue to make payments. Interest rates. HELOCs often have lower interest rates than home equity loans, but they can also be variable, which means that the interest rate can go up over time. Home equity loans usually have a fixed interest rate, which can make them a more predictable option for borrowers who want to know exactly how much they'll be paying each month. Access to funds. With a home equity loan, you typically receive a lump sum of money upfront and then repay the loan over time. With a HELOC, you have access to a line of credit that you can draw from as needed. This can be useful if you have ongoing expenses that you need to cover, but it can also make it easier to overspend. Fees. Both HELOCs and home equity loans can come with fees, such as closing costs and appraisal fees. These fees can vary depending on the lender and the amount of the loan. In summary, HELOCs and home equity loans can both be good options for borrowers who have equity in their homes and need to access funds. However, they have different repayment terms, interest rates, and access to funds, so it's important to carefully consider your options and choose the loan that best meets your needs.